So we have a stable outlook for the private sector banks, stable outlook even for the large 5 public sector banks, but we have a stable to negative outlook for the 20-25 odd mid-sized public sector banks in our coverage. Also, we have a stable outlook for the non-banking financial companies. In terms of the key challenges which we see for these banks are threefold. Number one, I think the weak capitalization for most of the public sector banks and the significant amount of capital they would require to transit through the Basel III transition over the next 3 to 4 years. Now our sense is most of these banks have very low internal accrual, very weak profitability, and a significant amount of dilution would be needed for them to really match up to the mandated Basel III ratios by March 19. The second key challenge which we see is in terms of risks from large stress corporates. Now there are a lot of large corporates which are sitting on these banks' books with minimal or almost no provisions, and some of them are so levered that they are almost close to a tipping point, and we expect some bit of delinquency from there onwards which could hit the banking system. The third and again a critical issue is the significant asset liability mismatch which some of these again mid-sized public sector banks are running. What it does is it makes them vulnerable to any extreme case liquidity shock and also makes it difficult for them to pass on any monetary easing. In terms of our own assessment of the capital requirement throughout the Basel III transition, the total number is about INR 5.2 trillion, broken into about 2.4 trillion required in common equity, about 1.6 trillion needed in hybrid AT1 bonds, and the rest in tier 2. Now as we see it, most of the smaller public sector banks would need anywhere between 40 to 50% dilution from their existing net worth to match up with this. Recently government has come and talked about infusing about 0.7 trillion in the banks, but we feel it could be inadequate because the balance, the remaining quantum which they need to pick up from the capital market is humongous, and many of these banks are trading way below their book value, and with the kind of profitability and the perception of their underwriting quality, it might be difficult for them to hit the market and raise that kind of money. The other aspect which we would want to focus upon is the development of the AT1 or the hybrid market. In our assessment, so far only about 10% of the required amount has been picked by investors, and the big investors like the insurance companies and the provident funds have shied away from this market. Unless this market deepens, this entire quantum would also need to be picked up through equity, which will make the task even more onerous. So these are the two challenges which we see in terms of the capital requirement. Credit growth clearly has been weak this year, both from a supply side and a demand point of view. On the supply side, if you see, the deposit growth has been tracking low because the nominal GDP has seen a shrinkage compared to last year despite the uptick in real GDP. But as the credit side goes, I think besides mortgage, little bit of retail and some refinancing, there has been absolutely no demand for credit. The infrastructure space in our assessment will still take about 2 to 3 years before it could create demand for any greenfield capex or project finance loans from the banks. Our assessment is about the private sector banks could still continue to grow at about 20% plus, the large 5 PSUs at 13 to 14%, but the smaller PSUs will struggle to hit even 10% growth over the next 3 to 4 years. So on a blended basis, you might look at something like 12 to 14% credit growth.